Let me start off with this dollar chart, looking at the comeback kit, if you will. The highest level since about mid-November, and the first quarter that we've seen of gains that is not, in fact, the right chart, but that is still a very useful chart across asset quarterly performance there. But certainly, are there concerns that the strength in the dollar is going to start weighing on risk sentiment?
Yeah, eventually just, it's a reflection really of the higher yields right now, which is implying a tightening of financial conditions, and that's quite negative. We're seeing that impact through commodity markets, oil and gold, too, which fell precipitously overnight. It looks like the dollar now, which had capitalized on weaker equities, is now starting to capitalize on higher yields and perhaps even U.S. exceptionalism. I think what we're really seeing right now in the markets are FX traders concentrating on stronger U.S. dollar against low-yielding at-risk currencies, specifically those currencies where the central banks remain quite dovish. And I'm just talking about the euro, for instance. And this is the reason, in my view, why the euro has come under a lot of pressure of late.
Stephen, I want to actually bring back the chart that we had before, which takes a look across asset performance at the end of the quarter. In order of performance, it's really commodities, stocks, the dollar, EMFX credit, followed by treasuries. What does the next quarter hold? Where are you looking at extending positions, and where do you think we've come to the end of the road for performance?
I think we're having a bit of a reality check correction here on two fronts. I think, the China credit impulse is dwindling slightly. Looks like China's looking to pare back some of the froth a bit. And also we've got this perhaps repricing in the short end Fed curve. And that's sort of weighing negatively right now. But, if we stop looking at the hair on fire arguments right now, we're looking at the way price assets right now are at very lofty levels. If we're looking at the stock market, for instance, we're at record highs despite yields going up. What does that tell me? It tells me that the market continues to have faith in the Fed's average inflation targeting. So I think there's still room to breathe here in the short end, provided the Fed doesn't hit the panic button and raise interest rates. Arguably, that's not going to happen for some time. So I continue to look at stocks. I think stocks continue to lift a little bit more. Looking at oil, oil is going to lift, but the big elephant remains air travel. When that happens, that's when oil will lift off. We need to get this COVID cases under concern. This is more of a medical concern rather than as a market concern, but it's all, adding on to this revolving carousel of risks that we continue to find ourselves on day in and day out.
You mentioned Biden's infrastructure package. Where will you see the impact across Asian assets?
It's interesting because the route here is it should be good for commodity prices, and that's ultimately that's where we would see looking at as far as Asia is concerned, we'd be looking at the Malaysia spectrum, who exports quite a bit of oil. We would think oil would get a substantial boost right now. But I think the problem we're having right now is how this thing is going to get paid for. And I think this is worrying equity investors quite a lot right now, because the fear is that all roads are leading to tax hike junction, and that's sort of a negative one. So I think when you're looking at these infrastructure packages, I think you have to take everything with a grain of taxman and salt. And until we get those conditions ironed out, I think things in general are going to remain a little bit unsettled. But getting back to the Asia risk, I think anytime you start to see more stimulus coming to the market, it hints of more exports, and that's one of the key things. So I think the growth factors in Asia, especially around Korea, I think those are the areas that we're going to continue to buy into.
Take a look at oil, one of the commodities that you mentioned. This GTV chart on the Bloomberg just showing how volatility has been surging. Of course, we had the Suez Canal fiasco as well. But when you're looking at the commodity right now, when you have the OPEC Plus meeting also this week, how do you trade this?
There's not such a big buy on dip as what there was a few weeks ago. And I think this is a reflection of a couple of technical things. One, obviously, the technical players have sort of been sold out of their long position. But we also look at the USO, more of the ETF buy-in that was really trading what we refer to a roll and carry trade, where you could collect a substantial yield by continuing to roll oil. That's also left the market. So what we need to see is prices settle in a little bit. And I think we're getting to that inflection point right now. I think OPEC is going to continue to monitor this market very closely. And, at least for the next month or two, I think we're going to continue to go down the tight production path. However, I think the writing is on the wall here. I think the two biggest combatants, Russia and Saudi Arabia, are certainly looking at things in a different direction here. Ultimately, Russia wants to pump more oil because they're in dire needs from a fiscal perspective. And that's going to end up, resulting in more oil coming back to the market at some point, whether next month or the month after. We have to face that reality check that more oil is going to be coming back to the market. So all that talk of a super cycle, I just don't buy into it right now.